Welcome to Speidel's California Minute. I'm your host, Catherine Sedan. This week we're covering tips for truly becoming a non-resident, as well as things not to do when trying to change residency. Register for the best year-end update and be prepared to tackle tax season with Speidel's federal and California tax update. We have in-person seminar and live webinar options available, and you can find more details at speidel.com. It's not easy to undo California residency, and although it's not impossible to change residency, the individual has to really relocate to the new state and sever ties with California. The tests for non-residency are facts and circumstances tests. A taxpayer who wants to become a non-resident will need to truly move and change residence and domicile, including selling the California home, leaving California employment, establishing and spending time in a residence located in the new state. This residence should be of equal size, cost, and amenities as the California home unless the taxpayers are truly downsizing. Establishing business and social ties in the new state, discontinuing business and social ties in California, tracking email and telephone calls to California from the other state to take care of business and personal transactions, and using registered or certified mail to mail important documents to attorneys, accountants, and others in California. The taxpayer will want to avoid doing the following: keeping the home and letting the children live there, maintaining a California business, having children in school in California, voting in California local elections, having mail sent to California, spending significant time visiting children or friends because every day spent in California will count against the taxpayer in a residency audit, or continuing to use California physicians, dentists, or other professionals who require the taxpayer's physical presence to transact business. When a taxpayer files a part-year resident return with a large amount of income received after the change of residence, the FTB will often begin the audit process. One of the first things the FTB will do, especially if the taxpayer still has property or lots of family in California, is to determine the number of days the taxpayer spent in California versus the number of days spent in the new state. They'll also be combing through data to find bank accounts in California and other states, examining credit card transactions to determine where purchases were made, and looking at where 1099 and wage income was reported, if returns were filed in other states, if the taxpayer purchased property in the other state, etc. It's also possible that the auditor will have visited Facebook, LinkedIn, Instagram, and generally searched the web for information about the taxpayer. When you advise your clients and prepare them for a domicile and residency change, dig deep into their plans. Only then can you advise them as to what they need to do if they really want to change their residency status. Make the break as clean and visible as possible. Because even if you win the inevitable residency audit, the cost to you and your clients will eat into the tax savings. Speidel's analysis and explanation of California taxes helps ease the burden of solving complex California tax problems when they come up in your practice. The 2026 edition will ship out in January. To order a copy, go to speidel.com and click Publications. That's all for this week. Join us next time for another episode of Speidel's California Minute.